Everyone, you're watching The Business of Law, the only web TV show focusing on the challenges and the opportunities facing the legal profession. I'm Lee Pacchia. We have Aric Press in studio today. Aric, of course, is the editor-in-chief at ALM, and he's the author of a really interesting special report on the state of BigLaw that came out late in October of this year. I'm thrilled that you came by and offered to unpack this for us. Good to see you.
Good to be here, Lee.
So it's tough to figure out where to begin with this one. I guess the first thing that jumped out when looking at the numbers, you broke them out essentially twice. That is to say, BigLaw performance, financial performance numbers. One had non-inflation adjusted numbers, and the other set had them included. And the results were dramatically different. On one hand, when you didn't have the inflation dollars added in, we had a year of records in 2013 with all sorts of records being set for gross revenue, profits, revenue per lawyer. And then when you add in the inflation adjusted numbers, it was almost the worst year on record, to quote. That's a big swing. How do you reconcile that difference?
Well, it is a big swing, and it shows the stress that the businesses of large law firms, many of them are under now and are likely to face for the foreseeable future. Revenue per lawyer, as you suggest, when in inflation-adjusted terms, was at a record low over the last 12 years. Meanwhile, profits per equity partner, the owners, had the 7th best year that they had over that time period. So they're doing in inflation-adjusted dollars. So the owners are doing better while the averages are dropping.
Yeah, I mean, just to break out a quote here, in 2013, RPL hit a record high of 776,000 in nominal terms and a record low of 438,000 in inflation-adjusted dollars. Tremendous difference.
Yes, absolutely tremendous difference.
Should we be reporting financial returns for BigLaw going forward in inflation-adjusted dollars?
I think we and everybody else will be paying more attention to inflation-adjusted results as well as nominal results, because that's what people have to spend. But inflation-adjusted makes more sense when you're looking at trend lines. I mean, we looked at overall spending by corporate America in this report. And what we saw over the last decade was a drop in constant dollars, in nominal dollars after the Great Recession began, and some recovery, kind of like a roller coaster effect. If you look at it purely in inflation-adjusted dollars, it's not a roller coaster, it's a water slide. It starts here and it goes like this.
So let's talk about the notion of full recovery here. If we have, with inflation-adjusted dollars, looking at the water slide, as you said, RPL hit a record low last year. Can we say that we're in a full recovery when we look back at the legal recession that started in 2007?
No, I don't think you can. These are high-class problems. Firms are doing, even firms that are supposedly troubled are doing, many of them are doing nicely. But the recovery has been very spotty, both between firms and within firms. There are a handful of firms that are clearly clicking on all cylinders. At other firms, you may have one practice group that's doing very well and another that's struggling, and sometimes within this same practice group. Litigation being the best example. You may have white-collar investigation folks doing exceptionally well, while the bankruptcy litigators are reading advance sheets because they don't have enough else to do.
They're switching gears here. There was so much in this report about how the nature of partnership in BigLaw is fundamentally changing. Can you unpack that a little bit for us?
Well, sure. There are now, in percentage terms, fewer equity partners, fewer owners than there were in 2004. There are also fewer associates than there were in 2004. What's happened is that there's been a growth in contract partners, income partners, or what we at the American Lawyer call them non-equity partners. 78% growth between 2004 and 2013.
Wow.
So there's a smaller group of owners and more people supporting them. Leverage has gone up from roughly 2.6 to 1 to 3.1 to 1. To put it in Churchillian terms, never have so many worked so hard to benefit so few. At the same time that there are fewer owners, there's constant, if not increasing, lateral activity. There's a willingness of firms to push out however they define underperforming partners or practices, or to demote them, to de-equitize them. There's a growing compensation gap between the highest paid person with the title partner and the lowest paid person with the title partner. So there's a whole variety of stresses that are roiling the traditional partnership structure. Too many firms are still organized, and for good or for bad, around the notion that they are small Quaker meeting style partnerships, where you could put all the partners around the conference table once a week, once a month, once a quarter, and make whatever decisions that were necessary. At most places, those days are over. We like to joke that at large firms now, many partners couldn't identify their fellow partners in a lineup. Mm-hmm. They have to wear name tags at partner meetings. It says a lot about the nature of partnership when you need a name tag in order to identify your partner.
No, these are fundamental changes that you're outlining here, and I can't help but sit here and wonder what the longer-term consequences are going to be. I mean, this sounds like something on the macro level that's going to make global growth for the firms out there that want to have global footprints, all around the world in a brand sense. DLA Piper, Baker McKenzie. Is it going to prove a bigger challenge because of the way partnership has changed in the last 10 years?
Well, I think what will happen, particularly at larger firms with those global ambitions, they will operate more like businesses, like mid-sized corporations of a couple $1 billion each, substantial businesses with partnerships, and to lesser or greater degree partners will have a say in the matter, right. But there'll be a serious administrative structure, there'll be full-time people, some of them lawyers, running the firm and leaving the partners, who might just as easily be called executive vice presidents, but they're called partners, to do what they do best, which is try to practice law.
Let's drill down on the non-equity partner class. I'm really interested to talk about what it's going to look like in 5 years. That's to say, whether it's going to be bigger or smaller. You outlined there's been this tremendous growth, 78% in the last couple of years, as to how many people carry that title. Non-equity partners are a funny thing. They're a source of tremendous controversy. On one hand, people say they're not incentivized to work as hard as equity partners. They block younger rock stars that are coming up through the ranks of firms. On the other hand, as you noted in your report, they're very profitable.
Correct.
With or the non-equity partner.
Well, my suspicion is that they will continue to grow, but not at the pace that they have for the last decade. One of the problems with the phrase non-equity partner is that it covers a multitude of different folks. One question is, by equity partner, is it someone on their way up, someone who has plateaued, or the third category, someone who's coming down? The first two firms have found, particularly well-managed firms, the first two categories of partner do quite well, both for themselves and the firm. There are morale and other issues at people who are being demoted, who lose their equity status. Frequently, they continue to underperform. Not always. It's an issue for what the firm is about, how they want to treat their partners, what they're willing to pay them. It's in many respects the future of the non-equity partner is as much a cultural issue as it is an economic one.
I want to pick up on a quote on page 11 of your report. I'm reading now. For all the broad market trends, each firm stands essentially as its own microclimate with its own market challenges. As a result, each firm needs immediately to assess where it stands and where it seems to be headed. Are firms doing that?
Some are, and they're to be congratulated. And the best firms, the firms that are succeeding, the firms that have strong cultures and strong economic performances, one way or another, they have gone through this exercise and continue to go through this exercise. They're not afraid of looking at themselves and their practices and their partners squarely and honestly. The question is, what will the others do? Some are behaving in exactly that manner. Others, for one reason or not, are choosing not to. My suggestion is that now is the time to look clearly and directly at who they are, who they want to be and how they're going to get there.
Aric, great report. Thank you for stopping by.
My pleasure.
It's Aric Press, Editor-in-Chief at ALM. If you'd like to see more of the stuff that we're working on, be sure to go check us out online. You can find us at mimesiswebtv.com. We also have a YouTube channel and a Twitter handle under the same name. I'm Lee Pacchia. Thanks for watching.